What's up guys, it's Michael here. In this video, we're going to talk about diversifying your portfolio. This is going to be a short introduction video and what is the theory behind diversifying your portfolio. Before I get into it, please click the like button down below and subscribe button so this video can be pushed out to more people so they'll understand what is the difference between why do people call it diversifying portfolio, why is it important, and how does it help generate new wealth sources. So let's get into it. So what is diversifying? So you look between the definition of the word. Diversifying means you split up to multiple parts and groups. And how does this apply to investing? Which is the theory is you don't put all your eggs in one basket. For example, you basically buy a product, right? If you buy a product, you always want a competitor to that product. Because if it's only one thing, one product, for example, let's look at computer parts, AMD, Intel. Thought of that right on the spot. So before, Intel was a dominant factor against AMD. And what did they do? They basically made a crappy product throughout the years and it had little to no improvement until AMD popped up. That is competition. And this affects diversifying too. So basically, if you put your trust into one company, and that company decides to go wrong or go, unexpectedly backwards, you are basically in trouble. So why diversifying is so important. The more diversity you have, the less chance for you to get screwed. It's simple. You're looking and managing risk at the end. So you can treat it as a rope. So a rope itself has a bunch of small little parts, other tiny strings together, bounded together, but they're not physically connected. So you look at cable ties. So when a cable tie snap, there's basically a bunch of cables in there. One cable tie snaps within that tens and thousands of cable ties, the whole thing will not collapse because you got like the other like 9,999 supporting in that one cable tie snap that could be replaced or fixed. This is the same theory that applies to diversifying. So I'm going to break down what are the differences between the two. It's going to be a pretty short video, but it'll give you a basic understanding what are the difference between each. So first, let's break down the stocks. So as I mentioned in my previous videos, diversify by putting yourself into stocks. Now, how do you do it? So what I do is I basically pick the ones that are well known. So things I will do research. So you look at Tesla, you look at Apple, Google, Amazon, Facebook, you look at those type of stocks and you do research on them and you invest in it. You put whatever money you feel comfortable and you split into like index funds too. Because those, I consider that category itself as a research stock. Basically, I did my research into it and I'm comfortable putting whatever money I put into it. And second part, how you diversify that portfolio even further. So here's the interesting one. I made a video. If you watch that video and you threw a like button on that video, I told you if I hit 1,000 likes, I'll replicate that method and put it up. So that one, I took the top 500 companies in the world, blindfold myself, and generate, random number generator 10 times on Google, and pick 10 companies I do not know. Basically, I've never heard of them. And if you haven't heard of them, or if you basically how I choose it, if you heard of them, you skip it. If you have not heard of them, like for example, waste management, I heard of that, but doesn't mean you have heard of that, right? As the viewer, if you haven't heard that, that's considered one company you can throw some investment in. Throw some money into there. So you take $100, throw it into there, whatever money you have, put it into there and pick within those 10 companies. It has to be 10 companies or how much you're willing to invest. So you have $100, split it to 10 times, $10 each into all those different companies. And that is another version of diversification for stocks. And the next one, you're going down the list, you're going from basically easy barrier entry to really hard barrier entry. And it's basically, I'm going to look at the four main ones. So first is stocks, and the next one is cryptocurrency. Cryptocurrency is a pretty easy barrier entry, super volatile, super dangerous, and at the end, it's becoming another different type of investment. You're getting eyeballs and traction to it. You look at Dogecoin, Shiba Inu, Bitcoin, Ethereum, Cardano, USD coin, keeps going on. Even, I could say it, but that green leaf coin, people know what I mean. So you put some investments of those, you pick those coins, like even it's a meme coin, right? Just, if you don't really like it, but you have never given it a try, you see all the people making money, just give it a try, put $10 into it. You're willing to lose $10, right? Put $10 into it, multiple of those coins, do some of the Doge, do some of the Shiba Inu, do some of the Cardano, put some $10 into it, and just leave it. That's another way of diversifying. So cryptocurrency, stocks. Cryptocurrency is not too many out there, and it's pretty risky too, because cryptocurrency is very volatile. So my suggestion is to pick the top 15 coins and just put whatever investment into it. Give it a try, each one of them. Except for unless you can't get a buried entry of Bitcoin, fine, right? That makes sense. Or you can buy like a portion of a Bitcoin. Next one is getting more difficult. Cars. Cars itself, it's a really high barrier to entry. So honestly, I think it's more extreme than a house. But cars as investment is very difficult because when you're looking at this one, you cannot really be picky on this one compared to stocks. You cannot go blindfolded because most of vehicles depreciate in value. It's because value is generated of how much people want that specific product. How much people want that specific product. So you gotta look at if you're trying to get into a value investment in vehicles, which is a lot of manufacturers, let's face it, do not like it when people do it, but people still do it anyway. So you gotta look at major brands. Like basically things, if you say Tesla is an investment vehicle, most likely, I hate to break it to you, is a no. Because it's mass produced, it's not limited. And the value of it, people want it, but they can get it brand new. Why do it have to get from you? So you gotta look at brands like Porsche, McLaren, Ferrari, Lamborghini, even Lexus LFA, Porsche Carrera GT, Pagani, Zenova, Bugatti. The list keeps going on. Koenigsegg. And those are a type of investment vehicles. Those are super high barrier to entry. If you're looking at that, that's another part you can get into. Same with painting and art. So paintings and art, I don't know much about it, but some people are putting into it, look into using that as a value investment because it's a way to fight inflation. Diversification is a way to fight risk and at the same time fight against inflation. That's the whole point of investing. If you invest, you have multiple sources and multiple hands that basically hand you money over. The next one, which is the fourth one, is the main one, housing. So housing is, how do you do investment in housing? You buy it and you flip it, right? No, that's not how it works. It's buying it, you keep it, and you rent it out. You try to either break basically even or make profit when basically getting a place. Most likely what you want to do is to make profit. If you're making, going negative, then there's something wrong. Basically, when your business strategies did not work. But it's okay if it didn't work. You're bound to take L's from time to time, take losses. If you take losses, you learn from it. What did you do wrong this time? Fine. If you did wrong this time, let's say like, oh no, I overvalue this property. Then you go for something else, no big deal. So how does a housing work? It's a high barrier to entry because you're paying over 6 figures. When down payment, you got a lot of things to manage, but it's a type of investment. It's a thing that you can manage time to time. So when you have enough investments, which is almost never, housing is another type. So what you do, you get a housing duplex, rent out most of the building. You can keep a place for yourself, or you can keep it for your friend, have them manage the property, and you either want to break even, make money, or whatever current house you live in, you got extra room, you don't mind sharing with other people. Some people will not do this because privacy is a big thing in America. But if you're willing to trade it out to make some extra money and revenue, that's one really good way to do it. Extra revenue and money means more money into other types of investments. So housing would be my fourth one that I would pick. And another high risk one too, high barrier entry, high risk. So that's all I have to go for diversification. But if you're looking for really easy barrier to entry, no more than an hour of work into it, definitely stocks and cryptocurrency. Those are the easiest ones to have low barrier entry. But at the end, the best thing to do in diversification is to put your hands into places that you know, that's the first one, and things you don't know. That's the second one. So for the second one, when you don't know, that one's way more risky because you don't know what's going to happen. But that's the same thing in investment. You never know what's going to happen. If everything goes wrong, by that time, I'm pretty sure the world would end. So if you see it that way, then you will dip your hand into investing because they're basically handing you free money. Who wouldn't do it? Even dividends too. So that's all for this video. I'll see you guys next time. Like, share, and subscribe. And I got an interesting video coming up for you guys. Peace.